Hey New Zealand, today we're going to look at what is the difference between fixed mortgages and floating mortgages. Now we get this question a lot, specifically for folks when they've just bought a home and it's a couple of years in, they start looking at the floating rate because they normally would have fixed. Today we're going to go through fixed versus floating, who fixes and what is a fixed rate all about, how does it get determined, and how to calculate the amount of interest you're paying on the fixed loan on your repayment. Then we're going to look at floating and who does that actually suit, what's the difference, and why are there no break fees for the floating. I hope you guys enjoy this video. We really want to provide value for everyone who's got a mortgage. So if you have a concern, comment, or perhaps you want to know a little bit more on what you could do better with your situation, feel free to subscribe and get in touch with us. Let's get into it. All right, fixed versus floating. Now, what's the difference? A fixed repayment, you have one repayment each month, each fortnight, or each week, and an agreement is made between yourself and the bank for the number of months that you fix. For example, 6 months, you have that one rate for the next 6 months, and when the 6 month finishes or closer to it finishing, you will be able to speak to your bank for a new rate across a 6, 12, 18, 24, 36, 48, or 60 months. So up to 5 years that you can fix for next time around. Generally, how you determine which one's better for you is by talking to a mortgage advisor or perhaps being really knowledgeable on what is happening with the OCR and the world events. Now, 6, 12, 18, and 24 months, fixed rates normally are dictated around what the cash rate is doing, whereas the 36, 48, and 60 month rate is based on world events like what's happening in the United States or what's happening around the world with wars, that sort of thing. So why is the floating rate higher? Essentially, the bank is giving you maximum flexibility to pay down debt. They don't really know how you're going to do it, but if you opt for it, they're gonna make less money. So if they make less money, they will increase the rate that they offer you. So when people see the floating rate, or the amount of people that actually use the floating rate is very little in New Zealand, mainly because people want certainty on the biggest debt in their life. And there are some players out there that are able to get around it because they earn high income. And that's who floating rate is rather suited for more. Now, why do fixed rate expires? Essentially, the bank is lending you money on a time period as to how much they can make on the lending that they're lending you. So if you're putting 20% of your skin in the game and the bank's funding 80% of theirs, they want to be able to return the money at a rate which benefits them and give you the flexibility of being able to refix or consider other options. Now, what are break fees? Let's say you're someone who thought that the world is going to end with some really high interest rates till the 10%, and you chose to fix for 4 years at 6.35. Now you're looking at the headlines and the rates of 4.99 and you want to go and break that. What you will need to do is talk to your existing bank first, because you made a deal with them to pay the lending at 6.35 for the next remaining 2.5 years or 3 years. And now that you're choosing to break it, the bank will calculate, okay, if you're paying me the money back by refinancing to another bank, I have to lend this money out at 4.99%. And that means I miss out on the 6.35 that you were going to pay me for the next few years. So now the margin that we're missing out on multiplied by the number of months is essentially going to be a break fee, because you are breaking the contract. Now with the fixed rate, essentially we go on to about 6, 12, 18, 2, 3, 4, 5 years, and then it stops. We don't go longer than that in New Zealand. We know that in the United States, there's a 30-year fixed term that you can go for. Rates are somewhere in mid-sixes for that, but we don't have that in New Zealand or even in Australia. Now, when it comes to the fixed rate, like I said, the 6, 12, 18, 2-year based off the OCR, 3, 4, 5 based off long-term events. So you'll be seeing right now on the fixed rates at the banks, the 3-year, 4-year, and 5-year generally higher than the 6, 12, 18, and 2, purely because there's uncertainty in the world and no one really knows what's going to happen with events 3 years, 4 years, or 5 years out. So that money is a little bit more expensive for the bank to source, and essentially that's why it costs you more as a borrower to be able to pay that back if you choose to fix for that long. Now you may fix for that long if you know that you want a consistent repayment for the next 5 years, because either you might be a property investor doing a development and you don't really want your owner-occupied mortgage changing a bit too much because you're forecasting your expenses 4 or 5 years out, depending on what sort of long-term decisions you're making. When it comes to calculating how much interest you're paying on each repayment, it's really simple with a fixed loan. So let's say you on 4.99%, and we'll get into this. So if you have a $600,000 mortgage on a 25-year term and it's at 4.99 and you want to work out how much interest you're paying, So if your scheduled repayment is 3,504 per month for 600K at 4.99 for 25 years, what you're gonna do is multiply the loan amount by the rate, and that will give you your annual interest cost. Then you will take this figure and you will divide it by 12, and out of that 3,504, you are paying 2,495 in interest. So you can see that these two numbers match up over here. And if you have your own mortgage, open up the app, check the repayment, get the loan amount multiplied by the rate, divided by 52, and you're gonna have how much interest you're paying on that debt per week, or you can divide by 12 for monthly or 26 for fortnightly. Now, going into the question of how break fees are determined and why are they charged, you're breaking a contract that you fixed on and that you promised you will be paying the bank on the money that they lent you. The experience with this sort of stuff essentially is that break fees are very high as interest rates are dropping very fast. When interest rates are rising very fast, break fees can be lower, because essentially the bank can make more money now that their interest rates are going up and you're breaking it. Do you know what I mean? But you wouldn't be breaking anything when interest rates are going high. So essentially this is an exercise which happens when interest rates are dropping. When it comes to floating, you've got variable, and they're different across all banks. You can pay as much as you want. Now, comparing two examples, let's say we have this person here with a 600K mortgage, 25-year term, 4.99% rate. They don't want to make extra repayments for the next 12 months. Their mortgage repayment is going to be more or less the same. Now we go to someone that's floating. Let's say you are a nurse that earns a lot of money and you do a lot of overtime, right? If you know that you can pay a little bit extra, you can go for a floating rate, which is about 5.94% right now at one of the major banks. You can choose two things. Essentially, you can have your minimum repayment that's floating, and if the floating rate drops because an OCR announcement happens, then this rate should update as well. But if you choose to pay extra anytime, so let's say you pay 300 extra here, and then you choose to pay another $750 extra here, and then you choose to pay another $1,000 here. What is going to happen as you pay this down, this number here is going to change. So everything on top of the 3,844 that you're paying randomly at any given time is essentially dropping the number of years that you've got remaining on the mortgage. If you have a big lump sum bonus that comes in for $5,000 that you want to smash the mortgage, your initial mortgage, which was tracking at 25 years at the start of May 2025, is now ending in 24.44 years, and your loan balance has dropped to about $588 for the month as you are paying down extra on top of the minimum floating repayment. So this does suit some folks, and normally it's higher income earners, and essentially can be a strategy to pay down the mortgage faster, because you don't get charged interest on the first time you're borrowing the money. In this example, 600,000, you're getting charged interest on the residual balance that is remaining over the course of the next 20, 30 years that you've got remaining. Now, with that being said, that's pretty much a real quick summary on fixed versus floating. To summarize, if you are a high income earner, you can section out the mortgage to put a little bit on floating and dump it really fast. Banks do allow up to 5% of the loan balance to be a lump sum payment that can hit directly the principal. If you are paying it off based on a fixed loan, we have a lot of different strategies we apply for different clients, depending on their life situation. If they're family planning, going overseas, renting out the property, looking to get into business, anything like that, your mortgage structure should reflect those changes. I hope you enjoyed the video. Thank you so much for watching. And if you do find any value in this, please subscribe and comment, and we look forward to hearing from you.